All right, so I want to welcome us all to this afternoon training session. It's our online training. And this afternoon, we're going to be looking at Introduction to Technical Analysis. We're just 11 online now. I believe with time, more people will get to join us. Good afternoon, Prosper, Babatunde Lawal, Adegoye Shegun. Who else is there? Akorede, Olukoya, Akpaniyeti. I think I've greeted some of us before now. All right, let's rush into what we have for today. Now, in trading, and this applies to all forms of trading, either stocks, commodities, cryptos, indices, and any other asset. There are three ways we analyze the market. Now, the keyword is analysis. Before you take a trade, online, it's advisable you first analyze the market. Analysis precedes taking trade. And that's the reason why trading online is not gambling. It's not gambling in any way. It's a function of your analysis. And analysis involves you knowing the direction where the market is expected to go to. So there are three ways we analyze the market. There is technical analysis, fundamental analysis, and sentiment analysis. I'll start with the fundamental analysis, though we're not looking at that exhaustively today. We're looking at the technical analysis. But the fundamental analysis simply talks about how government policies, central bank decisions, the natural disaster, war, and other factors like that affect the market. While with technical analysis, we're basically looking at the charts. We're looking at patterns on the chart that can point us into the future direction of price. And under sentiment analysis, we're looking at currency strength and weakness, or sometimes the overall mood market. But then in this class, our focus is going to be purely technical analysis. So we say that technical analysis is the study of price movement in the market, whereby traders make use of historic chart patterns. Take note of that keyword, historic chart patterns. Please, I will encourage us to, shut down our video. It will actually drag the feed. All right. So, I said technical analysis is the study of price movement in the market, whereby traders make use of historic chart patterns and indicators to predict future direction in the market. The keyword is historic chart patterns, meaning there are patterns that are historical. It means there are patterns in the market that have been consistent over a long period of time. And these patterns can point us into the future direction of price. The same thing also, there are indicators, there are technical indicators on trading platform, which can also point us in the future directions that the market is expected to go to. So we say that it gives graphical representation. Okay, just a second. All right, it gives a graphical representation of the past and present performance of a market, which can also guide us into the future direction. So technical analysis can help us to know what has happened in the past, and we can use that information to predict the future direction in the market. Like I always tell people, our role as a trader is to know the future direction of the market and now trade in the direction of that future potential direction market is expected to go. What are the benefits of technical analysis? One, it helps a trader to know the future market direction easily. Now, with technical analysis, just on the chart, you can know the direction the market is expected to go easily. Okay, somebody's saying that there's a feedback in the background. Is any other person hearing that? Please, I need a comment on this. Okay. I think I sent we don't try to do that. I think you don't. Then I will check my name. Hello, can you hear me now? Oh, can you hear me? Can you hear me, please? I want to know if you can hear me. You can hear me. All right. Is the feedback still there? Okay, we'll get to do something about that. Let's just continue. All right, so we say that it helps a trader to know the future market direction easily. And that's what technical analysis helps us to do. You can know the future market direction easily by deploying the usage of technical analysis. And two is that it helps the trader in finding the best entry and exit points. That is where and when to buy, sell, or exit by studying the past movement on the chart. So with technical analysis, you can actually know the point where you can place a buy trade, a sell trade, or even possibly where you can exit a trade. And thirdly, is that it helps the trader to know the characteristics of price movement in the market, such as trend, retracement, continuation, and reversal. And I tell you that these characteristics are very, very vital to your success as a trader. And we're going to be looking extensively at that in just, I think, the next slide from this one. And finally, the last benefit of technical analysis is that it is being used by most successful traders, both in the past and in present, in making profitable trading decisions. So you're not the only one using technical analysis. A lot of successful traders globally are using technical analysis to trade the financial market and make huge profits from it. Now, we want to look at the characteristics of price. And like I said earlier, this is very, very important for you as a trader. Now, the first characteristic of price is called a trend. Now, in trading, we say that the trend is your friend. You know, as a trader, our primary job is to identify the trend in the market and now to be able to trade in the direction of that trend. So a trend is a tendency for price to move in a particular direction over a period. Now, money is made when the market goes in a particular direction over a period of time. And trend can be long-term or it can be short-term. You know, it can either be a long-term trend or a short-term trend. Now, success with trading is largely tied to the trader's ability to identify trends and position themselves for profitable entry and exit points. And now this summarizes it. It says that success with trading is tied to the trader's ability to identify trends, meaning your job as a trader is to identify where the market is going, and you trade only in that direction where the market is going. So there are three types of trend. We have the upward trend, the downward trend, and the sideways. And you can see the diagram right on the screen. You have the upward trend being called the bull trend, the downward trend being called the bearish trend, and the range is the top one, the sideways trend. Now, in an uptrend, we see that this is where the general price direction of an instrument is upward. So in an uptrend, it means price is expected to go higher, to go upward. But then it doesn't just go upward just, you know, on a straight line. It does a series of zigzag movements, which is called a movement in the higher high and higher low. So it makes, instead of price to just go, you know, straight up like this, what it does is that it makes a series of higher high, higher low, higher high, higher low, higher high, higher low, and on like that. That is how price moves generally in the market. And it's called an uptrend. In a downtrend, this is when the general price direction of an instrument is downwards. So in a downtrend, price is making a series of lower high and lower low, lower high and lower low, lower high, lower low, lower high, lower low. So for each lower low is dropping down lower, and the overall trend is a downtrend, or otherwise called a bearish trend. And the third type of trend is called the sideways, otherwise called the range or consolidation. So any of these three names can pop up when you are describing this third type of trend. You can either say it's a sideways market, a ranging market, or a consolidation. They all mean the same thing. So this is where the general price direction of an instrument is not clear. There's no clarity around it. So it's not clear whether price is actually going up or coming down. So what happens here is that price is trading within a range bound by a resistance at the top and a support at the bottom. Or better still, you can say that it's trading within a set of parallel lines. So it's called range. And usually it's advisable to actually stay out of the trend. I mean, out of a range rather. So because the three things we do in trading, either you're buying or you're selling, you're staying out. You know, a range is a time to actually stay out, you know, of the market. Because if you don't, the movement is not specific, it's not direct, you may end up having losses. So this is a diagram that is showing us a summary of what we've learned so far. We can see here price broke out of a range into an uptrend, broke out below a range into a downtrend, again entered a range, broke out from the range downwards. So on the chart, if you look at the chart closely, you will see these three types of movements most of the time, either an uptrend, a downtrend, or a range. So the first characteristic of price is trend, and we have looked at that, and we have established the fact that the trend simply means the direction of the market. Now, the second characteristic of trend is called retracement. So we say that retracement is temporary price movement against the established trend. The key word there is against the established trend. So it means that if the trend is bullish, if there is a bearish trade within that bullish movement, it is called a retracement, because that bearish trade is, you know, and is a temporary movement against the established trend. So we say that this retracement is any temporary reversal in price within a major price trend. The word within is the key here. So it's within an established trend. And the diagram below just gives us, you know, an explanation on that. Here we can see that the overall trend here is a downtrend or a bearish trend. But within that bearish trend, there was a slight buying. There was a slight buying, and that is what is called retracement. Now, this happens to a lot of traders. So maybe you enter the trade is going in your favor. All of a sudden, the market seems to reverse on you, and out of panic, you close the trade. And shortly after closing the trade, market starts moving in the original direction. So that kind of movement usually is called retracement, which is a temporary movement of price against the established form. Now, after every retracement, the next price movement is called continuation. So we say that continuation is a continuation pattern, shows a tendency for the trend to continue in the same direction after a retracement. It means there is an overall direction before, you know, which was established at the time we identified trend. After the direction has been established, there was a retracement. And after retracement, there is a continuation of price in the original direction. For example, in the diagram here, the overall trend here is a bearish trend. Price entered into a consolidation phase, which can be taken as a retracement, and it broke out into a continuation, which is a bearish trade, which is in line with the overall trend on this particular instrument. So we have trend, retracement, and continuation. And the last of them is now called reversal. Reversal simply means a major change in the price direction of any trading instrument. A reversal can occur to the upside or downside. Following an uptrend, a reversal will be to the downside, and following a downtrend, a reversal will be to the upside. Now, it should be noted that the reversal is not a retracement. When you have a retracement, it's a temporary movement. After retracement, there will be continuation in the original direction, but a reversal is complete change of direction. As you can see in the diagram here, we have price moving in an uptrend, and it got to this point, and the next thing, there was a reversal to the downtrend. This is a diagram again in a much more detailed format. So we have trend, retracement, continuation, retracement, continuation, retracement, continuation. Then at this point, we have a reversal, which is a complete change in direction. In this instance, it's a change from uptrend to downtrend. In some other examples, it could be a change from downtrend to uptrend. Now, in a retracement, where if price goes against you in a retracement, if you're trading in the overall direction, there is no cause for alarm. But if it is a reversal and a trade reverses on you, to be honest, you may need to close such a trade in a loss, because reversal is a complete change in the market direction. Now, the question people always ask is, so how do we identify a reversal point? Because as a trader, one of the problems with traders, with a lot of traders, is that you see some people trying to place a buy very close to a reversal point. Now, if you are buying close to a reversal point, most likely you will end up with a losing trade. The best thing is to identify a reversal point, and instead of buying towards that period, towards that level, rather you look for an opportunity to sell and ride the trend downwards in the bearish direction, rather than buying close, to reversal point. So that's, brings us to that point where people ask the question, how do we identify reversal points? And I've been asked that question many times. Now, there are two ways to identify reversal points. One, you can use indicators. You can use indicators like stochastics. You can use indicator like RSI, which we're going to look at right now. In the next class, we're going to something more detailed than that. We'll look at support and resistance in the next class. But then I'll just quickly show you reversal, how you can use indicators to identify reversal points. So I'm going to flip over now to MetaTrader. All right, so this is the MetaTrader platform. I want to believe you can see my MetaTrader. Just for confirmation, if you can see my MT4, please type a yes in the comment section. All right, thank you, Bulus. All right, same thing, Mr. Akpan in Yeti. So let's check out. Okay, let's use the dollar index. Like I said, two indicators you can use to identify reversal points. You can use indicators called oscillators. Oscillators. What oscillators do is they help us confirm trend. So you come to the indicator section of the MetaTrader platform, this upper part, the one I circled up there, click on the drop-down menu, go to oscillators, and go to stochastic oscillator. You can see how I scrolled. Let me do it again. I'll click on the drop down arrow there, come to oscillators, click on it. Then I see the drop down menu. I go straight to stochastic oscillator and I click on that. Now this oscillator, you're going to use it with the default setting. You're not changing anything. So you have the levels, it's already preset 20 and 80. Visualization, leave it like that. Just leave everything the way it is. And click OK. All right. Okay, let me delete this other two. Now, how do we use this indicator called stochastics? There are two levels on this indicator, the level 80 and level 20. This is level 80 here. This is level 20 below. I hope you can see where I circled. Now, each time stochastic gets to 80. Now, 80 is called the overbought level, while 20 is oversold level. So what is oversold? What is overbought? Now, when price is trending up in a bullish direction, that is when it's buying, it gets to a point where it becomes overbought. Overbought means it has bought so high, the price is so high that it will likely not buy any further. And oversold means it has sold so low that it will no longer sell further lower. So when price gets overbought in the bullish direction, instead of buying, it reverses and starts to sell. The same thing if it gets oversold, instead of selling further, it reverses and starts to buy. So oversold, overbought and oversold regions on the stochastics, they are actually reversal points on the stochastics. All right, so this is stochastics I've applied on the 4-hour time frame. I will mark some overbought and oversold regions. So this place here is overbought. This place here is oversold. This place here is overbought. This region is oversold. So let's look at it. Let's use the vertical line tool. If you place the vertical line tool up there for the overbought region here, you discover that, like I said, that for stochastics, when price gets overbought, instead of buying further higher, it will likely reverse and start selling. So you can see stochastics here is at, if it's even above 80, yeah, it's above, it can be equal to or above 80, equal to or 20, depending on which side you're on. So in this instance, RSI is completely above 80, and we can see there was a sharp reversal in price. The next point here, price is oversold, which is around this region, though there was a range, but with time, price equally reversed into the bullish direction. Okay, again, this is an overbought level, which coincides with this region. You can see there is a massive bearish breakout. This is an oversold level. There is a massive bullish breakout. This is an overbought level. There is a massive bearish breakout. So this is how we can use stochastics to identify overbought and oversold level. And this can give us an insight into the next move of price, where the price is going next. It means whenever you see stochastics at overbought level, we're expecting to look for an opportunity to sell. When you see stochastics at oversold level, it means we're looking for an opportunity to buy. Now, it should be noted that stochastics works better on higher time frame compared to lower time frame. So you get better results with stochastics if you're using it on like 4-hour or daily time frame. 1 hour, I would say use a caution. The best of it is to start from 4-hour time frame to use the stochastic oscillator. The next indicator I want to share with us, which can also help us identify reversal point is I'll come to oscillators again, and I'll go to relative strength index. Now you may need to do some little adjustment to this one. The levels come as level 30 and 70, but then we'll normally add 50 to it by clicking the add button and 50. I click OK. Now, for the RSI, it's slightly different from stochastics, though they work almost in a similar way. For the RSI, level 70 is the overbought level. 70 is the overbought level. 30 is the oversold level, and 50 is the midpoint. So it means when RSI hits 70, we are looking for opportunity to sell. When it hits 30 or below 30, it means we're looking for opportunity to buy. For example, the RSI is below 30, and we can see price reversed into the bullish direction. RSI here again at 30, you can see there is a sharp reversal into the bullish direction.
Do you know when you?
Yes,
you are not here.
okay.
When you went from here,
Okay.
you go see.
All right, again, this is RSI
You saw them
at 70, and you can see it's a massive bearish breakout. This is RSI above 70, some range, but then price still crash. All right, so this is how to use the RSI and stochastics to identify bought and oversold movement in the market. And this can be an edge for you as a trader to filter your trades in order to get more quality trades. So this afternoon, we'll be able to look at the beginning part of technical analysis, and we mentioned technical analysis, how to identify reversal points, characteristics of price, trend, retracement, continuation, and reversal, and a host of other things. Okay, it's a short training this afternoon, and we're going to be putting it to an end here. If you have any question you want to ask me on what we've done so far this afternoon, and just go ahead and either type in the comment section, or you can unmute your mic and ask your question, and I'll be right here to answer you, whatever you want me to explain better. So the floor is open for questions. Any question? Okay, while we're waiting for questions, don't forget tomorrow we have a physical training at both the Abuja office and Lagos office. This is PU Prime Africa. We have 2 offices in Nigeria, Abuja, which is the head office of Nigeria, and Lagos, the regional office. Physical training session holds twice a week at these 2 locations. 10:30 a.m. for Abuja office tomorrow, and 11 a.m. for Lagos office. The address of the Abuja office is at number 50 Ebitu Kiwe Street. That is the Walk and Connect building. 50 Ebitu Kiwe Street, Jabi, Abuja. Time again is 10:30 a.m. tomorrow, Tuesdays and Thursdays. And the Lagos office training will start by 11 a.m. The address is Agos Executive Business Lounge at 54B at Denny Jones Avenue, Ikeja. And also don't forget, tomorrow we're having live trading of CPI. CPI is Consumer Price Index. It's a volatile news event that comes up in the forex market once a month. Last week we had the NFP. Tomorrow we're having CPI. Join us tomorrow by 1:15 p.m. so that you can trade CPI. And the only condition for you to join our class tomorrow is you need to have a funded trading account with PU Prime. So if you don't have an account with PU Prime as I speak now, just go back to our website at www.puprime.com and open a live trading account. Your account manager will reach out to you and guide you through the registration process. Once that is done, verify your account with your document, which can be your government issued ID and maybe your NEPA bill or water bill, for your proof of address, and go ahead fund the account so they can trade live with us tomorrow. Tomorrow, we're going to be trading with expert traders who will guide you, tell you the entry price, take off stop loss, and other things you need to know about the news tomorrow. Okay, Ajibolo Lakule, how can we find the indicators on phone? Okay, there's going to be a MetaTrader 4 training session on phone, and we're going to explain that better when that session takes place. It's not what I can show us right here at the moment. Okay, let me see if I can just give me a second. If I can lay my hand on the slide and just show you in a minute.
There's no time.
Okay. All right, so I found the slide. All right, so this is what the MetaTrader 4 looks like. MetaTrader 5 looks slightly different from this, but if you can understand MetaTrader 4, then you'll be able to use the MetaTrader 5. All right, so for the MetaTrader 4, this is the way the home screen looks like. The button up there, right here, is the trade button. This dollar button is there for you to pick on currency pairs you want to trade. And this is the menu that takes you where you can add some indicators, like Fibonacci and the others to your chart. And this is the function button, with which you actually get to where to add indicators. This one is for placing trades, but then, correct. So if you want to add indicators on your MetaTrader 4 mobile, just tap anywhere on the screen. This blue dashboard will show up. It contains a time frame for all financial assets. Now, if you are adding indicator, when you click on the screen and this blue circular menu appears, then you click on the function button. Click the function button, that's the F button there, and you'll be taken to this menu where you have the main chart indicator window, from where you can actually add the indicators you want to add. So under the indicator window, you can add your trend indicator, that's the first menu, followed by oscillators. And I told us that RSI stochastics are both oscillators. So we'll find both of them under the oscillator menu. All right, this is not really a detailed slide on how to add indicators, but definitely once you come under the trend, you can select whichever indicator you want to attach. Let's assume it's average true range. Just select it, and once it's selected, you click OK, and it will just appear right on your screen. But then we'll have a more comprehensive training on how to use the MetaTrader platform, especially on mobile. So I believe I've answered that person to an extent in the request. Let's have the recordings after this. Surely you just watch out some minutes after this class ends. The link to the video will be available in your WhatsApp group. Go ahead and watch it. All right, so in the absence of further questions, we've come to the end of this training session this afternoon. I believe you've picked one or two things there which can help you become a better trader. We'll have another session again very soon. Like I said, watch out in your WhatsApp group, in your Telegram channel, any group you belong to for PU Prime. You will get the link to this recording in a matter of minutes after this class. You can watch it over again to get better understanding of the concepts that we share in this training session. All right, take care and enjoy the rest of the day. Bye-bye.